On July 22, 2025, President Trump stood in the White House and announced what he called the single largest foreign investment commitment ever secured by any country in history. Japan, he said, would invest $550 billion in the United States, $550 billion, in semiconductors, energy infrastructure, critical minerals, pharmaceuticals, shipbuilding, artificial intelligence, and quantum computing at Trump's personal direction. Through a special investment vehicle managed by the Department of Commerce, the money would arrive before January 2029, the end of his second term. In exchange, the United States would reduce tariffs on Japanese goods from the 25% level to 15%. The deal was signed. The Memorandum of Understanding was inked on September 4, 2025, by Commerce Secretary Howard Lutnick and Japan's lead trade negotiator. The White House issued a fact sheet describing it as a new chapter in bilateral cooperation that would unleash the full potential of the U.S. economy and support American workers for decades to come. Yesterday, April 30th, 2026, Bloomberg published a Rhodium Group report that contained the most consequential sentence written about the U.S. investment market in the past 60 days. The sentence is specific and precise. It reads, "Chinese foreign direct investment in the United States is unlikely to rebound meaningfully, even if Washington and Beijing restart high-level negotiations that are expected to place such investments on the agenda." Rhodium Group tracked the data. Chinese FDI in the United States, which peaked at a cumulative record in the 2016 and 2017 surge, has fallen 90% from that peak. In 2024, China ranked 17th among countries investing in the United States, with $589 million in new FDI. 17th, behind Ireland, the United Kingdom, Japan, Germany, Canada, France, Australia, South Korea, Switzerland, Singapore, the Netherlands, Sweden, Israel, India, Spain, and Italy. Italian companies invested 4 times more in the U.S. than Chinese companies did over the past 5 years. In 2025, only 2.6% of China's total global foreign direct investment went to North America, down from 27% a decade ago. And today, the day before the expected Xi-Trump summit in mid-May that was supposed to signal a reset of the bilateral economic relationship, Rhodium Group has told every investor, every business planner, every policymaker who reads its reports that the summit will not change this. The headline says the summit is coming. The data says the investment freeze is permanent. The question this video answers is what it means when the 2 largest foreign holders of U.S. financial assets, the 2 nations that collectively define the Asian economic relationship with the United States, are simultaneously pulling back from the American market in ways that are not temporary and not reversible through a single bilateral summit. By the end of this video, you're going to understand exactly what Japan's $550 billion investment pledge actually is, why the Federal Reserve Bank of St. Louis, Nomura Research Institute, Piper Sandler, and every serious analyst who has read the Memorandum of Understanding has concluded that it is more accurately described as a low-cost, risky loan than as an investment, and what that means for the American economy's need for Japanese capital. You are going to understand what China's FDI collapse, from 17th among investing countries to $589 million in 2024 against Ireland's $30.1 billion, means for the specific sectors of the American economy that depend on foreign direct investment to maintain their competitive position in technology, manufacturing, and supply chain infrastructure. You're going to understand what the DXY dollar index at 95.76, its lowest level in nearly 4 years, tells you about how global currency markets are pricing the simultaneous withdrawal of Japanese and Chinese financial commitment to the U.S. You're going to understand the sell, America dynamic, that J.P. Morgan's chairman of market and investment strategy, Michael Kembelest, identified as having occurred only 13 times since 1970, and never since 1981 until last year, in which U.S. equities fall, the dollar weakens, and Treasury yields rise simultaneously, and why the combination of Japanese institutional repatriation and Chinese FDI freeze is producing this dynamic at the worst possible moment in the American fiscal calendar. And you're going to understand what the Lowy Institute's March 2026 analysis described as Japan's wicked conundrum, and why the resolution of that conundrum will determine whether $550 billion of Japanese capital actually lands in American factories and power plants, or whether it becomes the largest diplomatic fiction in the history of U.S. trade negotiations. Let us start with the Japan investment pledge, because it is the story that every American financial institution is analyzing, and almost none of them are describing accurately. In July 2025, the United States and Japan reached a bilateral trade framework agreement after months of negotiations, prompted by Trump's initial imposition of 25% tariffs on Japanese goods under IEPA. The core bargain was this: Japan would reduce its effective tariff exposure to 15%, and in exchange would commit $550 billion to a jointly managed investment vehicle. The $550 billion would be deployed at Trump's direction into energy, infrastructure, and production, including LNG and grid modernization, semiconductor manufacturing, critical minerals, pharmaceuticals, shipbuilding, AI, and quantum computing. The projects would be recommended by an investment committee chaired by the Secretary of Commerce, and Japan would have 45 business days to decide whether to fund each recommended project. If Japan declined to fund a project, it could face higher tariffs, or what the MOU called catch-up payments. Profits from funded projects would be split evenly between the two countries until Japan recouped its investment, then 90-10 in America's favor. The structure is extraordinary. The United States government retains absolute discretion over which projects receive Japanese capital. Japan must deploy the capital within the Trump administration's timeline or face tariff penalties. The profits that flow back to Japan come at rates that the Trump administration controls by controlling which projects are selected. The Federal Reserve Bank of St. Lewitt, in a November 2025 analysis, described this structure precisely. Japan's investment pledge effectively functions more like a low-cost but risky loan to the United States. Japan's investment appears to carry substantial risk without adequate compensation. If fully implemented, this deal could generate significant revenue for the U.S. government at the expense of the Japanese government and ultimately Japanese taxpayers. Risky loan. Those are the words the Federal Reserve Bank of St. Louis used. Not investment, not partnership, not bilateral cooperation. A risky loan that carries substantial risk without adequate compensation. And then Takahide Kyuchi, executive economist at Nomura Research Institute and a former Bank of Japan policymaker, said in a July 2025 note precisely what every Japanese corporate executive was privately thinking. The investment pledge is merely a target and not a binding promise. In reality, under the Trump administration, many Japanese companies likely view the business environment in the United States as deteriorating due to tariffs and other factors. Furthermore, at current exchange rates, labor costs in the U.S. are extremely high, providing little incentive for Japanese firms to expand investment there. If anything, we may see a stronger trend toward diversifying investments away from the U.S. Diversifying investments away from the U.S. That is a former Bank of Japan policymaker's published analysis of what the $550 billion investment pledge actually implies for Japanese corporate behavior. The gap between the political headline, the largest foreign investment commitment in history, and the economic reality, a risky loan structure that Japanese companies view as providing little incentive to deploy capital, is the specific gap that explains what is happening in the U.S. market right now. The second round of $550 billion projects was announced on March 20th, 2026. It included up to $40 billion by GE Vernova Hitachi in Tennessee and Alabama for small modular reactor power plants, and up to $33 billion in natural gas generation facilities in Pennsylvania and Texas. Japan Times covered the announcement. The White House issued a fact sheet. Prime Minister Takaichi visited the Oval Office. The headlines described it as further evidence of the investment flowing. But the detail that the headlines obscured is the word up to. Up to $40 billion. Up to $33 billion. Not $40 billion. Not $33 billion. Up to. And as Just Security's legal analysis published in November 2025 noted after the first round of announcements, the same companies have merely expressed interest in possible projects, no binding contracts have been signed, and the proposals remain under review by the administration. Expressions of interest, under review. In the language of actual investment, expressions of interest and under review mean that no money has moved. No commitment has been made that would hold up in a commercial dispute. No construction has begun. No contracts have been executed. The $550 billion promise is, in the specific language of the people who have read the MOU most carefully, a framework for future possible investments, many of which may not materialize, funded through a loan structure from the Japan Bank for International Cooperation and other government-affiliated institutions, managed by an investment committee that the United States government chairs, with profit-sharing terms that heavily favor the United States. Piper Sandler analysts were more direct than any other institution in describing what this means for U.S. market expectations. They wrote, "Our trading partners and major multinationals know Trump's tariffs are on shaky legal ground. Therefore, we find it hard to believe many of them are going to make massive investments in the U.S. they would not have otherwise made in response to tariffs that may not last." Tariffs that may not last. That is the specific constraint that converts the $550 billion headline into the investment freeze that Japan is executing right now. Japanese companies are being asked to commit capital to multi-decade infrastructure projects in the United States, in energy generation, semiconductor fabrication, and shipbuilding, based on a tariff regime that was struck down by the Supreme Court in February 2026 in its IEEPA form, replaced with a Section 122 tariff that expires on July 24, 2026. and whose long-term replacement is currently being contested in the Court of International Trade by 24 state attorneys general. No rational corporate capital allocator commits $3 billion to a Tennessee nuclear power plant because a tariff structure that may be legally challenged again by the time the plant is operational makes the investment slightly more attractive. The investment calculus requires long-term policy certainty that the current tariff architecture does not provide. The Lowy Institute's March 2026 analysis of Japan's $550 billion pledge identified the structural tension that makes the investment freeze not a temporary hesitation, but a structural constraint. The analysis, titled Behind Japan's U.S. Investment Pledge, a China Problem, noted that Japan faces the wicked conundrum of being forced to either exit the China market or double down on major investments to regain competitiveness. Japanese companies in the automotive sector are watching Chinese EV manufacturers capture Southeast Asian market share that Japanese hybrids and gasoline-powered vehicles previously dominated. Japanese electronics and semiconductor firms face Chinese competition in markets from Southeast Asia to Latin America. In this environment, the strategic decision for Japanese corporate capital is not between investing in the U.S. and investing at home. It is between investing in the U.S. under American political direction through a risky loan structure and investing in the rest of Asia and the developing world where Chinese competition is the primary strategic risk and where the investment is subject only to Japanese corporate governance rather than Commerce Secretary oversight. The wicked conundrum is the reason the $550 billion investment pledge is producing a frozen market rather than a capital surge. Japanese companies that would rationally invest in the United States under conditions of policy certainty, competitive labor costs, and market access reliability are instead in a posture of wait and see, watching whether the Section 122 tariff survives its legal challenges, whether the July 24th cliff produces a stable replacement tariff regime or a policy vacuum, and whether the Commerce Secretary's Investment Committee selects projects that generate commercially viable returns rather than politically attractive headlines. While they wait, the investment is frozen. $550 billion of announced investment, essentially zero of binding committed investment with contracts executed, ground broken, and capital transferred. Now let us look at China, because the Chinese story is not waiting for a political event. It has already happened. On April 30th, 2026, one day ago, Rhodium Group published the most comprehensive analysis of Chinese foreign direct investment in the United States since the collapse of that investment flow began in 2017. The findings are not ambiguous. Chinese FDI in the United States has fallen 90% from its 2014 to 2017 peak. In 2024, China ranked 17th among countries investing in the United States, with $589 million in new FDI, compared to Ireland's $30.1 billion as the top investor. Cumulative Chinese direct investment in the U.S. over the past decade reached approximately $190 billion, less than a fifth of the $1 trillion figure floated by Xi and Trump during their September 2025 Madrid summit. The gap between what was floated diplomatically and what has actually flowed commercially is not a matter of rounding. It is an order of magnitude. In 2025, only 2.6% of China's total global foreign direct investment went to North America, compared to 27% a decade ago. China's $100 billion greenfield investment in 2025 went primarily to Asia, the Middle East, Sub-Saharan Africa, and Latin America. Asia received approximately $40 billion, driven by manufacturing investments, data centers, and raw materials, mining in Vietnam, Indonesia, Malaysia, and Thailand. The Middle East and North Africa received large-scale manufacturing and clean energy projects. Sub-Saharan Africa received major energy and materials processing investments. The United States received $589 million. $589 million against a U.S. economy of $29 trillion, against an annual federal deficit of nearly $2 trillion, against infrastructure investment needs that the American Society of Civil Engineers estimates at a multi-trillion-dollar shortfall. China invested less in the United States in 2024 than it invested in a single mid-sized Malaysian manufacturing hub. Rhodium Group's analysts, led by Thilo Hannemann, explained why this is structural rather than cyclical with a sentence that should be read by every investor analyzing the U.S. capital inflow outlook. Washington's national and economic security concerns will continue to limit Chinese participation in core areas of the U.S. economy. More importantly, Chinese regulators now treat outbound investment in greenfield manufacturing projects as a potential channel for technology leakage, industrial erosion, and job losses. Both governments have simultaneously concluded that Chinese investment in American strategic industries is undesirable. The U.S. government has said so through the Committee on Foreign Investment in the United States review process, through export controls on advanced semiconductors, through the executive order banning American investment in Chinese military-linked companies, and through the regulatory apparatus that has blocked or unwound Chinese acquisitions of U.S. technology and infrastructure companies across multiple sectors. The Chinese government has said so through its own outbound investment regulatory framework, which now treats greenfield manufacturing investment in the United States as a risk of technology leakage and industrial capacity transfer that Beijing's industrial policy does not want to facilitate. Bilateral negotiations, a summit, a trade deal. Rhodium Group's analysts are explicit that none of these will address the core reasons for the slowdown, which are deeply embedded in U.S.-China strategic competition and distrust. This is the second leg of the freeze, not a withdrawal of capital that was there and has been pulled, a refusal of capital that might have come but will not, because both governments have constructed regulatory frameworks that prevent it, and because the Rhodium Group data confirms that Chinese corporate behavior is fully aligned with those regulatory frameworks. The $589 million is not a temporary trough. It is the structural floor of Chinese FDI in the United States for the foreseeable future. Now let us connect these two stories to what is happening in financial markets right now. Because the simultaneous freezing of Japanese direct investment and Chinese FDI is not occurring in isolation. It is occurring alongside the Japanese institutional repatriation from U.S. Treasury securities, the Chinese PBOC's 17 consecutive months of gold buying at the expense of dollar-denominated reserve holdings, and the specific market dynamic that Michael Kembalest of J.P. Morgan named the Sell America moment. The dollar index DXY, which measures the dollar against a basket of major currencies, fell to 95.76 on April 27, 2026. That is the lowest level in nearly 4 years. President Trump, responding to this decline on Truth Social, said he thought it was very good and that the dollar was doing very well. He added that China and Japan had continued efforts to weaken the yuan and the yen, calling that unfair. The irony in that statement deserves full examination. The dollar is at its lowest in 4 years. The president considers this good because a weaker dollar helps American manufacturing exports and reduces the real cost of servicing dollar-denominated debt. And simultaneously, the president is accusing China and Japan of deliberately weakening their currencies. Both things cannot be simultaneously true as a coherent economic narrative. The dollar is not falling because China and Japan are deliberately weakening their currencies. The dollar is falling because global investors, including Japanese institutional investors, and Chinese reserve managers are reducing their dollar-denominated asset holdings. Fewer buyers of dollar assets means lower demand for dollars. Lower demand for dollars means a weaker dollar. The DXY at 95.76 is the market's vote on the credibility of the dollar as the world's dominant reserve and investment currency in a world where its two largest Asian creditors are simultaneously in various stages of disengaging from dollar-denominated assets. Japan is reducing its treasury holdings through portfolio repatriation driven by rising JGB yields. China is reducing its treasury holdings through the structural diversification into gold that has been running for 17 consecutive months. Both countries are simultaneously not committing new capital through direct investment, Japan through the vaporware character of the $550 billion pledge, and China through the regulatory freeze that has produced the $589 million 2024 trough. The Sell America dynamic that Kembalest identified as having occurred only 13 times since 1970 is the financial market's expression of this simultaneous disengagement. It is the pattern in which U.S. equities fall in price, the U.S. dollar weakens against foreign currencies, and U.S. Treasury yields rise, all at the same time, over a sustained period of at least 30 days. Under normal circumstances, when U.S. equities fall, the dollar strengthens because global investors flee to dollar-denominated safety assets, and Treasury yields fall because investors buy Treasuries as the safe haven. The Sell America pattern breaks both relationships simultaneously. Equities fall, dollar falls, Treasury yields rise. The combination means that the traditional safe haven flows are not occurring. The financial markets are not treating the United States as the destination for risk-off capital that it has been in every crisis since the 1980s. The Sell America dynamic implies that at the margin, the risk-off trade is going somewhere other than U.S. Treasuries and U.S. dollars. Where is it going? Gold at approximately $4,800 per ounce. Japanese government bonds, whose yields have risen to 2.38% on the 10-year, the highest since 1999, making them competitive with currency-hedged U.S. Treasuries for the first time in a generation. European sovereign bonds, which are benefiting from European rearmament and fiscal expansion. And BRICS payment infrastructure, which, as a previous video in this series documented, processed $178.5 billion in a single day through China's CIPS system in March 2026. The specific fiscal consequence of Japan and China simultaneously freezing their U.S. market engagement is felt at the Treasury auction. Every month, the United States Treasury must sell enough government securities to fund the federal government's operations, service the existing $38.86 trillion debt, and finance the approximately $1.9 trillion annual deficit before war supplementals. The buyers at those auctions are primarily American financial institutions, money market funds, pension funds, insurance companies, and foreign investors through their custodial accounts. When foreign official demand, the structural buying from central banks and sovereign wealth funds that historically has provided a reliable base of Treasury auction demand, shifts from structural buying to neutral or mild selling, the auctions must clear at yields that attract sufficient private demand. Private demand is price sensitive. It requires higher yields than official demand. Higher yields mean the U.S. government pays more to borrow. The January 2026 Treasury International Capital data, covering the first month of this year, showed total net foreign acquisitions of U.S. long-term securities at $28 billion against an analyst forecast of $128.6 billion, and against December 2025's $206.6 billion. A one-month drop from $206 billion to $28 billion in foreign demand for U.S. long-term securities is the financial market's receipt for what happens when Japanese institutional investors and Chinese reserve managers simultaneously reduce their appetite for U.S. assets in a month that preceded the first month of the Iran war. The next TIC data release on May 18th will cover March 2026, the first full month of the Iran war's impact on capital flows. It will tell us with specificity how much of the $28 billion January miss was a temporary disruption versus a structural change. But the data that is already available, the DXY at 95.76, the 30-year Treasury at 4.91%, the JGB 10-year at 2.38%, and the PBOC's 17 consecutive gold purchases all point in the same direction as the January TIC miss. China's Treasury holdings were $693.3 billion as of February 2026, down from $760.8 billion at Trump's January 2025. Inauguration, a 10.2% decline in 13 months. In January 2026, as covered in the reporting cited earlier in this video, China's holdings had already fallen to $682.6 billion, the lowest since September 2008, and the PBOC has been adding gold for 17 consecutive months, with gold's share of China's total foreign exchange reserves having surpassed 9% for the first time in November 2025. The ANZ Banking Group estimates that China's actual gold holdings may be approximately double the official figure, at around 5,500 tons. If that estimate is accurate, China's gold position would rank second globally, behind the United States, and the portfolio shift away from dollar-denominated assets would be substantially larger than the official data suggests. The Rhodium Group report from April 30th confirms what the Treasury data has been showing gradually. China's disengagement from U.S. capital markets is not limited to the Treasury portfolio. It encompasses direct investment, venture capital, financial market participation, and the entire spectrum of cross-border financial flows. Bilateral negotiations could provide some guardrails, the Rhodium analysts write, but it would not address the core reasons for the slowdown, which are deeply embedded in U.S.-China strategic competition and distrust. The competition to dominate artificial intelligence has mostly sealed off from each other the hundreds of billions of dollars in spending by the industry. Washington's executive order banning American investment in firms with ties to China's military, and the forced delisting of certain Chinese firms from U.S. stock exchanges have created a regulatory barrier on the U.S. side that mirrors the regulatory barriers China has constructed on its own side. The term Rhodium Group's analysts use for this bilateral structure is strategic competition and distrust. It is a compound phrase. Strategic competition is the public framing. Both governments acknowledge they are competitors for technological dominance, manufacturing capacity, and geopolitical influence. Distrust is the private reality. The United States government does not trust Chinese capital with access to American strategic infrastructure, as evidenced by CFIUS review processes that have blocked or unwound acquisitions from Chinese entities in semiconductor, aerospace, technology, and energy sectors. The Chinese government does not trust American regulatory frameworks with control over Chinese corporate investment decisions, as evidenced by its own outbound investment regulations that treat greenfield manufacturing in the U.S. as industrial capacity transfer risk. When both governments simultaneously implement regulatory frameworks that prevent capital from flowing between them, the investment freeze is not a negotiating tactic. It is the natural output of two regulatory systems that have independently concluded that bilateral capital flows in strategic sectors are a national security risk. A trade deal, a bilateral summit, a diplomatic framework agreement, none of these changes the underlying regulatory conclusion. The Rhodium Group's finding, published the day before this video, is the most recent and most authoritative confirmation that the freeze is structural. Now let us look at what this means for the United States economy specifically, because the simultaneous freezing of Japanese and Chinese engagement with the U.S. capital market is not a financial market abstraction. It produces specific, measurable, real economy consequences. The first consequence is the cost of government borrowing. The 30-year Treasury yield at 4.91% reflects a buyer pool for American government debt that has lost two of its largest structural participants. Japan's institutional investors, who spent 25 years buying U.S. treasuries because JGB yields were near zero and the hedged treasury trade generated positive returns, are now in a structural transition toward JGBs as domestic yields rise. Japan Post Bank, with its $550 billion in foreign bonds, the Government Pension Investment Fund, with its $400 billion in U.S. assets, the regional banks and life insurance companies that collectively define the Japanese institutional buyer base, all of them are recalculating the arithmetic of the Treasury trade as the 10-year JGB reaches 2.38%, and the cost of hedging the dollar-yen exposure approaches 3.5 percentage points annually. The conclusion of that arithmetic is less buying, not zero buying, less. China's official treasury holdings at $693 billion, down from $1.316 trillion in 2013, represent a 13-year structural reduction of more than 50%, not a tactical sale. A structural reduction over a decade and 3 different U.S. presidential administrations, driven by a Chinese institutional conclusion that concentration in U.S. dollar-denominated assets that the United States government can freeze, as it demonstrated with $300 billion in Russian central bank reserves in March 2022, is a sovereign risk that China must manage through diversification. When these two structural buyers become structural sellers or structural non-buyers, the Treasury auction must clear at higher yields. Higher yields are higher borrowing costs for the U.S. government. Every 10 basis points of additional yield on the 10-year Treasury translates into approximately $45 billion of additional annual interest expense as the debt stock is refinanced at higher rates. The 10-year is currently at 4.31%. The 30-year is at 4.91%. If the structural demand reduction from Japan and China forces an additional 50 basis points of yield across the curve over the next 2 years as the debt rolls over, the additional annual interest cost exceeds $225 billion. That $225 billion does not disappear. It is borrowed at the same higher rate, compounding the trajectory. The second consequence is the technology and manufacturing investment gap. The United States has articulated an explicit industrial policy goal of rebuilding domestic semiconductor manufacturing, critical minerals processing, shipbuilding, energy infrastructure, and advanced manufacturing. The CHIPS and Science Act, the Inflation Reduction Act's manufacturing provisions, the Bipartisan Infrastructure Law, and the tariff regime's stated purpose of incentivizing domestic production all reflect a government commitment to reversing decades of industrial offshoring. That goal requires capital. Specifically, it requires foreign capital to supplement domestic investment, because American savings rates and domestic capital formation are not sufficient to fund the investment required at the pace the industrial policy ambitions demand. Taiwan, South Korea, Japan, and European countries have announced or begun semiconductor fabrication investments in the United States. TSMC's Arizona fabs, Samsung's Texas fab, SK Hynix's Indiana facility, and TSMC's second and third Arizona fabs are real investments with real capital committed and real construction underway. These are not vaporware. But they are also not Chinese capital and not the scale of Japanese capital that the $550 billion pledge represents at face value. If the Japanese investment is largely expressions of interest rather than committed capital, and if Chinese capital is structurally frozen by bilateral regulatory frameworks that neither government is willing to change, the U.S. industrial policy ambition is more dependent on domestic capital and on non-Asian foreign capital than the headline bilateral diplomatic announcements suggest. The third consequence is the dollar's purchasing power internationally. The DXY at 95.76 is not merely a financial market data point. It is the price at which every American business purchases imported goods, every American consumer buys imported products, and every American tourist exchanges dollars abroad. A weaker dollar, at the margin, supports American export competitiveness, but it also increases the cost of every imported input into American manufacturing, every imported consumer good, and every energy import beyond what the domestic energy market produces. In a tariff environment where import prices are already elevated by 15% through the Section 122 regime, a simultaneously weakening dollar adds to the effective cost burden on import-dependent businesses and consumers. The specific irony is that the administration's goal of a stronger American manufacturing base is partially undermined by the investor behavior that its policies have produced. Japanese and Chinese investors withdrawing from dollar-denominated assets puts downward pressure on the dollar. A weaker dollar increases the cost of U.S. imports at the same time the tariff regime is increasing them. The dual pressure of tariffs and dollar weakness is a double taxation on American consumers and businesses that import, and a partial subsidy to American businesses that export, in a pattern that redistributes purchasing power within the economy, rather than creating it. There's a fourth consequence that is less discussed than the others and may be most significant over the longest horizon. It is the AI and technology investment gap. Rhodium Group's April 30th report stated that the competition between the US and China to dominate artificial intelligence has mostly sealed off from each other the hundreds of billions of dollars in spending by the industry. American hyperscaler cloud providers and enterprise platforms are projecting capital expenditure that exceeds $700 billion in 2026, according to various analyst estimates. Chinese AI investment is significant but domestically oriented. The sealing off of bilateral AI investment flows means that the capital pools for the most consequential technology race of the 21st century are running in parallel rather than in competition, with neither side benefiting from the efficiency that cross-border capital allocation would theoretically provide, and both sides bearing the cost of building parallel rather than interdependent infrastructure. The J.P. Morgan Asia Private Bank's 2026 Outlook, published in December 2025, noted that Chinese AI capex is projected to exceed $70 billion in 2026, approximately 15 to 20% of U.S. hyperscaler spending. China's strategic push to build foundational layers for generative AI and large-scale machine learning is real and funded. It is not dependent on American capital. American AI investment is also not dependent on Chinese capital. Both are large, both are growing, both are domestically funded and domestically oriented. The sealing off is mutual, voluntary, and structural, and it means that the efficiency gains from cross-border technology investment, which drove the previous decades of U.S.-China economic integration, are no longer available to either economy. The Z-Trump summit expected in mid-May is the next political event that financial markets are treating as a potential catalyst for reversal of some of these trends. The summit is expected to be structured around trade and technology, with Chinese investment in the United States as one of the agenda items. Rhodium Group's report, published one day before this video, is the most current independent assessment of whether that summit will produce a meaningful reversal. The conclusion is unambiguous. A trade deal could help revive Chinese FDI to some extent, but is unlikely to trigger a new investment boom. Bilateral negotiations could provide some guardrails, but would not address the core reasons for the slowdown, which are deeply embedded in US-China strategic competition and distrust. The Rhodium assessment is not pessimistic for its own sake. It is empirically grounded. The total Chinese FDI in the US over the past decade reached $190 billion. The $1 trillion figure floated during the Madrid talks represents a commitment to invest, in a decade, more than 5 times the total of the entire prior decade's investment. For that to occur, both the American regulatory environment for Chinese investment and the Chinese regulatory environment for outbound investment to the United States would need to change fundamentally. Neither government has signaled willingness to make those changes. CFIUS review remains active. Export controls remain in place. The Chinese outbound investment regulations that treat greenfield U.S. manufacturing and risk technology leakage risk remain in force. The summit will produce language. It may produce announcements. It will not produce the structural regulatory changes that would convert expressed interest in investment into committed capital. Now, let us bring the full picture together. Because understanding what Japan and China are doing to the U.S. market requires holding all of the threads simultaneously. Japan signed the largest foreign investment commitment in history in July 2025. The commitment is a risky loan structure that Japanese corporations view as unattractive because U.S. labor costs are high, tariff policy is legally uncertain, and the investment selection is controlled by the American Commerce Secretary rather than by Japanese corporate capital allocation processes. The $550 billion is expressions of interest, not binding contracts. The second round of projects announced March 20th included up to $73 billion in nuclear and natural gas projects with no binding commitments. Japanese institutional investors are simultaneously repatriating from U.S. treasuries as JGB yields reach levels not seen since 1999, and the energy import bill from the Iran war narrows Japan's trade surplus and weakens the yen. The DXY's decline to 95.76 reflects, in part, the reduced Japanese institutional appetite for dollar-denominated assets. China has made it structurally impossible for its companies to invest meaningfully in the United States, and has made it unnecessary by building its own AI, semiconductor, manufacturing, and energy infrastructure investment ecosystem that does not require American market access. Chinese FDI in the U.S. in 2024 was $589 million. In 2025, 2.6% of China's global FDI went to North America. The Chinese PBOC has bought gold for 17 consecutive months, reducing the share of its reserves in dollar-denominated assets. China's treasury holdings have fallen from 1.316 trillion in 2013 to 693.3 billion in 2026, a 53% reduction over 13 years. The simultaneous expression of these two freezes in financial markets is the sell America dynamic that Michael Kembalist identified as having occurred only 13 times since 1970. Equities falling, dollar falling, treasury yields rising, all three simultaneously. Not because the American economy has collapsed, not because a recession has arrived, but because the structural buyer base for American assets, concentrated in Asian institutional capital and Asian sovereign reserve management, is changing its relationship to the American market in ways that are not temporary and not reversible through a single summit or a single deal. The Japan freeze is about regulatory structure, tariff uncertainty, and the arithmetic of capital deployment in a high labor cost environment with politically directed investment selection. The China freeze is about strategic competition, mutual regulatory exclusion, and the 17-year culmination of the post-2008 trend toward Chinese investment autonomy. Both freezes are real. Both are structural. Both are confirmed by the most current data available. The $550 billion headline and the $1 trillion Madrid summit figure are the political expression of what both governments want the relationship to look like. The $589 million and the 90% FDI collapse are what the relationship actually looks like. On this Friday, May 1st, 2026, the DXY is at 95.76. The 30-year Treasury is at 4.91%. The PBOC has been buying gold for 17 consecutive months. Japanese institutional investors are doing the arithmetic on JGB yields versus hedged Treasury returns and concluding that staying home is rational. The Rhodium Group published its assessment yesterday that the Xi-Trump summit will not change the structural investment freeze. The U.S. market is not crashing. The economy is not in free fall. But the structural capital flows that sustained American borrowing costs, American dollar strength, and American access to foreign investment capital for the past 2 decades are changing. They are not changing because of a single event or a single political decision. They are changing because two governments that together control the largest pools of foreign capital available to the American economy have independently concluded, for reasons rooted in their own strategic interests, that the optimal allocation of their capital is increasingly away from the United States. That conclusion was not announced in a press conference. It was not made in a summit communique. It was made in the Treasury International Capital data, in the Rhodium Group's investment tracking, in the BOJ's rate normalization decisions, and in the $589 million Chinese FDI figure that made China the 17th largest foreign investor in the United States in 2024. 17th. Behind Italy, behind Spain, behind India. The market freeze is not dramatic. It is structural, and structural changes in capital flows do not announce themselves. They appear first in the data, then in the yields, then in the exchange rates, then, eventually, in the cost of every dollar that the American government borrows, every factory that American industry needs foreign capital to build, and every technology investment that the American economy needs foreign participation to fund at the scale the moment requires. The DXY is at 95.76. The freeze is already in the data.